The Silicon Valley Bank collapsed. Why did they collapse? Well, to start off, they had deposits of $173 billion, cash on hand of $17 billion. They had this big run on the bank. They had $42 billion worth of withdrawals on Thursday. That was caused when they tried to raise $2.2 billion, mostly in preferred stock, on the public market. When a lot of these big companies saw that, they rushed to withdraw a lot of their money because they saw this as a big red flag. So when they did that, they were short a lot of money. Now, why were they short money? Well, they only have to keep 10% on hand, and they had that $42 billion worth of withdrawals. So that was a big deficit there. Now, normally, this wouldn't be a big issue if a bank had a lot of short-term government debt. They would just sell it to satisfy the demand. As long as they had more assets, they did liabilities and deposits, they wouldn't be insolvent. But what happened was they bought up a lot of long-term government bonds at rock-bottom prices when rates were very low. At rock-bottom rates, I mean. So when you do that, for example, if you were to buy a $100 bond with a par value of $100 and the rate was 2%, if the Fed starts aggressively raising these rates and all of a sudden the yield has got to go to 4%, well then the bond's only worth $50 now. So that's a big issue for them. I mean, they had roughly $91 billion of these bonds, and those are only going to be worth maybe $55 billion. Maybe 50 to 55 billion. So it's a $41 billion loss. They had roughly $200 billion in assets. Subtract the $41 billion loss for these bonds that were supposed to be held to maturity. And that gives you 159. Subtract 173 for the deposits, and that's a $14 billion deficit, which is a big issue if everybody's starting to rush to withdraw everything and they can't. So yeah, that's why they're insolvent, because there's a negative. They have more liabilities to their creditors and depositors than they have from these investments, because they leverage the deposits to buy a bunch of long-term bonds when the rates were so low. It doesn't take a genius to tell you, if you're buying a bunch of bonds up at 2%, why would you buy 30-year bonds? Why? At that rate? And for a big bank? I'm not sure why they would do that. And when they did do that, when the rates went up aggressively, those bond prices went down aggressively, because that exposes you to a lot of risk. They did yield more than the short-term bonds, which is why they did it. But if they had any foresight, then they would know that the Fed was going to raise rates quite aggressively, or even if they thought there was going to be modest raises, they didn't have to be as big as they are to have a huge loss and to possibly make them insolvent. So this is why they are insolvent. Silicon Valley Bank, that's why they collapsed. And now the FDIC is taking over to try to sell everything and try to get the customers' money back, and try to satisfy the liabilities.